Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Let's start. Once again, I don't think there's too much new news on Iran, so I hope to hold the discussion of Exhibits C and B, and A for that matter, to only 5 or 6 minutes. On Exhibit C, I attempted to put down new numbers for crude supplies and crude demand. And you'll see the inventory draw is just about 2 million barrels a day. Now, 2 million barrels a day is 700,000 barrels in total. I think an inventory draw of that magnitude is feasible. I always have U.S. inventory, and if you cite down at the bottom of Exhibit C, U.S. inventory of crude products runs around 1 billion barrels. This is different than our national reserve. I frankly forget what we have in the national reserve, maybe 500 million barrels or something like that. But I think there is inventory. I believe there's statistics I've seen that China keeps 1 billion barrels of reserve of crude. And the other thing I've seen reports on is that they have not really drawn that much of it down. So there is room in the system to accommodate a draw of some amount without having prices go much higher than where they are now, which is in the near months, somewhere in the 90s, and in the price 12 months out, somewhere in the low 70s. I think that is what is going to prevail, even though there's clearly a standoff where we have embargoed all ships in and out of Iran, so they're not going to be able to ship any oil, and they have effectively closed the straits, combination of missiles, drones, and these speedboats. Apparently there's thousands of them, most of them made in Iran and referred to by news commentators as the mosquito fleet. So I think as investors, we should assume that this situation just prevails, and then we'll see whether or not the industry has enough resilience, both in terms of inventory, in terms of taking oil out of the Persian Gulf, across Saudi Arabia to Yanbu, or in Abu Dhabi's case, out to Fallujah, which is outside those straits, or in Iraq and Kuwait's case, taking it north out through Turkey and Syria. My guess is, maybe I hope it's an informed guess and not wishful thinking, is that even if this standoff between Iran and the U.S. prevails and is something that just goes on indefinitely, that we can avoid having pricing that's too much more than what the futures curve is. If we turn to Exhibit B, last Thursday, the near month price was 92. As you can see, in 27 for the full year, the price is 73. When you look at 26, the prices in January and February, which were in the $60 range, and then the prices realized since then in the futures price, the price for all of 26 comes in just under 80. It's 79. These are manageable prices. If you go back to 24, the price of oil averaged about 73 or 74, and then averaged a full $10 below that in 25. So now, politically, $4.50 gasoline is gotta, for the party in power, the Republicans, that's gotta be bad. Now, I don't think at $90 oil, once things settle down, it's not clear to me that the gasoline price will be $4.50. I would think, they're 42 gallons in every barrel. Now, gasoline has to be processed out of crude. So you got to add something, $10 a barrel or $15 a barrel or something for the refiner. I don't think that translates into $4.50 gas. There's some state and federal taxes in it, but I would think you might get down to $3.50 gas, something like that. So that's my commentary on Iran. While we're on defense spending and whatnot, the Trump administration, if we go to Exhibit A, you can see that the defense spending has been pretty steady in 24, 25, and the 26 fiscal year budget at just under $1 trillion. They are asking for $1.5 trillion for the fiscal budget that starts next October 1. I don't think they're going to get $1.5 trillion. I think that what they're doing is trying to get the defense budget and the equipment that our Air Force, Army, and Navy and Space Force use substantially updated. And I think that they're making some success. I mean, I think they do have some success. And I just don't think it's going to be that disruptive to our budget, which is important because that deficit has to come down. This is not sustainable to have our public debt be more than 100% of GNP. And we can't tell when it'll become a capital markets problem, but there's a certain inevitability to it. And the best thing to do would be to get the trend going in the other direction. We've been concentrating on companies' positions. Too often it's called moat, which is a good term, I guess, but I think it's more than moat. I mean, a moat means you've got some type of a cash flow position that you can sustain. I think what we've been trying to do, we looked at Lilly, we looked at Microsoft, we looked at Amazon and Walmart together. We looked at Apple last week. I think what we're trying to do is to have some intelligent insights or something bordering on predictions for how these major companies are going to fare. And the company for this week is Meta. And we want to leave time for some healthcare and we want to leave time for news. But I personally, Meta is on page 4. I personally don't really like Meta. Or I mean, I understand that they, all the advertising revenue they achieve, and I understand they're delivering a service, but it seems to me that they are spending all this money on installing GPUs, and it's not clear to me. And I know that Mike and Jason will make it clear, but it's not clear to me, or it's hard for me to understand why they're putting all that money in. I mean, I understand why Amazon is doing it, why Microsoft is doing it, why Google is doing it, why Oracle is doing it, because they're offering their services, basically off-site servers or cloud or compute or whatever you want to call it. The question in my mind is, what is Meta doing? And with that as a lead-in, Mike and Jason are going to take it from here. And I reserve the right sometime in the next 5 or 10 minutes to ask a question, but basically the floor is theirs on Meta.
All right. So Meta, we've got them at $200 billion in revenue, growing at 33% year over year. Fairly impressive. The products they have are Facebook and Instagram, which are kind of their stable cash cows. Reels, a TikTok-like product that has started to kind of take over some of that TikTok market share. They've got some upstart products, Stories and Threads, right? They've got the Ray-Ban Meta glasses, which they're clearly not making money on. Speaking of which, I did go to Best Buy and do the demo of the Ray-Ban Meta glasses with the display in it. It was interesting. I wouldn't I don't know that I would buy that, but the technology is very cool. Very cool.
How does Meta make money?
Fortunately, you're not the first person to ask this question. I'm going to rewind to, I think it was 2018, and play this clip from a Senate committee hearing.
Mr. Zuckerberg, I remember well your first visit to Capitol Hill back in 2010. You spoke to the Senate Republican High-Tech Task Force, which I chair. You said back then that Facebook would always be free. Is that still your objective?
Senator, yes. There will always be a version of Facebook that is free. It is our mission to try to help connect everyone around the world and to bring the world closer together. In order to do that, we believe that we need to offer a service that everyone can afford, and we're committed to doing that.
Well, if so, how do you sustain a business model in which users don't pay for your service?
Senator, we run ads.
Jason and I are cracking up because we think this is hilarious. But to catch you guys up, that was a Senate committee hearing. And yes, Facebook is free, but nothing's truly free. What you are exchanging.
You are the product.
You are the product. Whenever you're not paying for something, you are the product. And Facebook, or the company Meta, and all these different products are basically attention machines. And what they do is they get you to spend lots of time on them. And when you spend lots of time doing anything, that's a great opportunity to sell advertisements. And that's what TV was. And if you look at hours watched on TV and how a lot of that has shifted to the internet, much of that has also shifted to Facebook or the Facebook properties. And what's really amazing about Facebook and Instagram in particular is that they have become extremely effective advertising mediums, because if you advertise on TV, for example, maybe you have to hit somebody many times in order to get a message across. With Facebook and Instagram, they can present you with a product that you never knew existed, that you never knew you wanted. And if it's placed in front of you at the right place in the right time, you may very quickly go from discovery of a product that you've never seen to purchasing it, moving down the funnel at a pace that really is remarkable. So thinking about the business here, Facebook and Instagram are just phenomenal from an advertising perspective. They have all these other products, and basically the goal is, how do you build a scale network economy product or network effect product that you can surface ads on in a creative and engaging way that doesn't degrade from the user experience. Back to artificial intelligence, where does that fit in to what Meta's been doing? I would say that Meta has been the largest and most profitable AI application ever. And I guess it's relatively easy pickings when you compare it to most of the companies that are like OpenAI are losing money. Meta's been making money with AI for a long time. And the most notable part of this is they began using machine learning at least as far back as 2007 in ranking their advertisements. With the idea being, if they are compensated on click-through rates, they want to present the right ad at the right place at the right time, because it's a kind of a self-fulfilling incentive system that it's good for the advertiser, it's good for Meta. And these early models were actually all run on Nvidia hardware. Meta developed a lot of the tools that many machine learning and artificial intelligence researchers write their software in. PyTorch, for example, is one of their projects. So they've always been on the leading edge of artificial intelligence. What we'll say is that the investments that they made in machine learning, they also took a long time to play out, to figure out how to incorporate that into the product. We're still in the early stages of large language models and how large language models turn into profitable investments. They have been somewhat public about they obviously have an LLM that's accessible through their applications that you can chat with. I don't think that's been a great driver of engagement for them so far. My understanding is they are using large language models in part of the advertising ranking and exchange side of the business. But does all of this investment that they're doing today, is the upside justified? And if you listen to the most recent earnings call, Meta was challenged by many analysts on what they expected their return on investment capital to be. And the answer was basically, we have no idea. And thinking about their business, it's not like they're renting out the servers. So they don't have a customer lined up ready to pay X and knowing that they're going to invest Y to put this infrastructure in place. So it doesn't have a nice, satisfying answer to it. But this company has done a very good job of monetizing a attention machine that is really unlike any other. And I think that's the main thing, is that I think of their advertising medium is a lean back in medium that also enables you to go from discovery to purchase in one shot. And you compare that to Google search, where you go to Google search with an intent. It's like, I want to buy a LG washing machine. Yeah. And you're just going to search for the best price and the location to get it. You don't do that on Instagram. Instagram presents you with a product that you didn't know, like maybe an LG steam closet, which I had no idea what that was until very recently.
You own one now.
I now own one. Yeah. So it's a different type of advertising medium. So I think when you think of the moat of this business, it's one, there's a massive network effect with Facebook. That's what keeps people on, what keeps people going back. But the other piece is that it is a uniquely well-designed product in that it has very good properties for advertisers.
So I'll put some numbers on it. I think really the inflection was when Apple announced they were going to implement ad tracking transparency, which that was letting the user know that an app was going to track you as you go to use other apps and surf the web. So naturally, everyone said, no, I don't want to be tracked. And that crushed Facebook mainly, but Meta's ability to attribute a purchase or a view of a website, a product, back to the ad that they served you. And that was around the 2021, 22 timeframe. So at the time, Meta's revenue was about 110 billion annually. And from 21 to 22 was the first year that they did not experience growth. It was completely flat from those 2 years. So that was really the impetus for them to implement a lot of AI tools around how they predict who's going to view an ad, click on it, how they're going to react to it, how the traffic at the advertiser's website is going to be affected by these ads. And they were really able to bring the attribution back to, you're going to spend X dollars on advertising along with Meta and see a return of Y dollars. So from that time until today, Meta's revenue run rate today is now 220 billion, which is exactly double that of it just 4 years ago.
And growing at a 30% clip.
Right. So that's the return they're seeing from AI.
Jason, why did they put out their own language model, which no one thought very much of? And why have they changed all their AI people out? Why is all that happening? If Mike's thesis is right, which is they're the ones who are really making a gross margin on machine learning or AI.
Yeah, my view, and it's completely speculative, but they had a panic moment and they hired a bunch of AI researchers and they were kind of just throwing spaghetti at the wall to see what sticks. And a lot of those researchers may not have ever seen any of their work be used. And from both sides, they're probably looking at themselves and asking why they're in this organization, this big organization, and not seeing their work's not seeing the light of day. At the same time, Meta is going to look at them and say, this group of people hasn't produced a product that, are part of a product that we've implemented into our family of apps. So,
well, I'd say the reason that they're doing all that is more because they believe that, and Zuckerberg's talked about this on an earnings call, artificial intelligence is presenting a paradigm shift of sorts in the technology landscape. And they view it as existential if they fail to capitalize on this shift.
Yeah.
Then
Well,
it may not be relevant 10 years from now.
and they also tried the VR route. That didn't pan out.
There's a secondary thing that I think is probably less profitable or less likely to be profitable, is that because of the conflicts with Apple, Meta and Zuckerberg in particular has been very focused on trying to own whatever the next platform they participate in. And that's very clear from the glasses. And if you've ever used the Meta glasses, they're actually very impressive. Again, the display one with the augmented reality display in the glasses is a little weird to use, but you can definitely tell that this is where the future is going. Now, today, that currently still has to connect to your phone, has very limited capabilities because Apple wants 30% of whatever transactions were to occur on that device. So it really can't do much. It even just does a pretty poor job of navigating you if you want to use it for navigation. Basically, you want this company investing some amount of money so that it has new products so that it can continue to grow its cash flow over the long run.
Right.
The argument or the reason people are maybe not happy with Meta is that they think they're spending too much and not returning as much capital to shareholders as they ought to.
He's really an entertainment business now, but he still clings to the idea of he's connecting people. And I think Instagram's moved this way, and certainly as TikTok's become competition, that I think there's a future where one or he has a collection of apps and that serve the user AI generated content for entertainment, pure entertainment purposes.
Right. Well, we're going to have to hold it there. I think that's a really lucid explanation of why Meta deserves credit for getting to gross margin and cash flow from machine learning, artificial intelligence, however we want to characterize it. It also, I think, shows how difficult it was for OpenAI to be advertising supported, because you have to deal with Facebook and Google and these people are very good at what they do. And by the way, in this process we're going through of testing where these companies' positions really are, I think the logical one to do next week will be Google. And the question there will be, they've done terrific. They're an all-time stock price high. They're flirting with $5 trillion. But the original problem for Google was how much of their search business would they lose to OpenAI, to the initial chat product. And that's still a question. So that's what will be on our agenda next week. Any news on page one? Apple, Amazon, Alphabet, Microsoft, Tesla? It's noteworthy.
Amazon has news. They've announced a new business called the Supply Chain Services Division. So they've built out the US's largest logistics network, and now they're going to offer that as a service, not just if you sell products through the Amazon marketplace, but if you just need to ship items around the country. So they really are now a direct competitor to UPS and FedEx.
Yeah.
The other thing to point out that's relevant to the advertising discussion is OpenAI is launching an ad platform, a self-service ad platform. Where that competes in the stack of advertisers is somewhere in between maybe Google and Netflix, because it's not going to be great, or Twitter for that matter. It's not going to have the relevance or intent necessarily that, maybe it'll have similar intent to Google. So it's probably most squarely targeted at Google, I'd say.
Sure. That's for next week. That'll be part of our discussion next week. When are the Nvidia earnings? Are they next week?
Yes.
Yeah.
Yes. Oh yeah, next week right after the call. So
yeah, Nvidia is a month after everyone. Their fiscal year end is the end of January. So we get through all the earnings releases and then we still have Nvidia to go. So Musk says his goal is to get to Mars, says his goal is to put data centers in space, says that he is going to build, I think he calls it Terra facility in Texas that will be competitive with TSMC. So in terms of making chips. And I think that, that's something I think we'll address a couple of weeks from now. We'll try to, especially after this trip to China, we'll try to evaluate where Taiwan Semiconductor stockholders, what they should worry about. Jason, healthcare news, we lose our FDA commissioner who was, you people were reasonably high on, but he's a victim of, I don't know what he's a victim of. The FDA being unable to be led, or what? Jason, how would you characterize that?
Yeah, I was and still am a fan of Marty Makary's, but the FDA, and I don't know if it certainly wasn't all his doing, but the FDA was in a little bit of turmoil. There was a lot of layoffs and everything before he became the commissioner. Controversial picks. Vinay Prasad was in, he was out, he's back. It's unclear if that was Marty's pick or RFK Jr.'s pick or anyone else's. So there was a little upheaval, but I think in general, he was doing a pretty great job at the FDA. He had some unpopular decisions that were made by the FDA under his watch. And in the last couple of weeks, there was a lot of press around that, which was interesting. And the main point of contention was the denial to approve a melanoma treatment by Replimune. And that got a lot of airtime. And so I kind of went back and did a post-mortem of why that occurred and was my opinion of that wrong. And what I found was interesting is that Replimune designed their study. They were testing their drug in combination with another therapy, and they designed their study as a single-arm study. So to get in a little bit of details here, but they didn't have a control group, and they didn't have a way to prove that their product was the one leading to the efficacy versus the other drug used in combination with theirs. And then they cut their trial short when they enrolled just 10% of their patients. So under the last administration, the FDA said that was a poor trial design, and they went with it, and they still submitted the data, and it got denied by the FDA twice. So the bottom line is Mike and I found in our previous work with software startups and clinical trials is that a very good drug can still fail because you design a study in a poor manner. And I think that's what happened here. And they were a victim of that, kind of their own doing, even though the drug worked, or apparently worked, or the combination certainly worked. There was not enough evidence to approve it. So I don't know who was involved with that company and who their allies are. There was kind of a concerted effort to put out hit pieces against Marty Makary in the last couple of weeks.
Yeah, I think it's interesting because they obviously cut corners in the study.
Biotechs are under cash pressure, and they have to make some cuts. They have 100%. To cut some corners. So
100%.
Yeah. It's just interesting. So in the same day that he announced his resignation, the FDA also launched 2 real-time review studies, and one each sponsored by Amgen and AstraZeneca. And the idea there is that as data is collected through the study, it's the investigators or physicians at the clinic actually conducting the study are inputting the data into a software system that the FDA has access to, and they can, in real time, update their analysis on safety and efficacy of those treatments. So those kind of initiatives are a huge push forward at the FDA. It's roughly half of the time spent of the decade that takes to get a drug to market is you're putting the data package together, you're submitting it to the FDA, or the FDA is reviewing it. It's time spent where the drug's not an active, study. So right. The goal there is to really compress timelines, and the industry is, until COVID occurred, the industry was paper driven still. So I think this is a huge carrot to kind of get them to modernize, and at the same time compress timelines, which is good for patients to get access to treatments earlier. It's good for the drug companies because the drugs are more valuable with more time on patent. Yeah, I don't know. I don't know what to make of it. I'm kind of disappointed. I think he got a lot of bad press, but there's a lot of good things happening that didn't see any airtime.
Agreed.
Any other health news, Jason?
HARO reported earnings. I'll let Mike describe it, but at a high level, the company, this is the second quarter in a row where the company operationally did really pretty well, but then kind of fumbled on the financial side of things. So if you want to describe that, I'm the one that always rants against PBMs.
Hey, it's another PBM story. So the long story short is they got status on the formulary for CVS. And so everybody's excited. They're going to start selling into CVS. That means more access. But then you start having to deal with some of the particulars of this industry. And that would be rebates, insurance plan deductibles, all of these things. And HARO has this program called HARO Access for All that basically guarantees that you can buy it for $59. We have some theories as to exactly why it flowed through the way it did, but we got a lot of high deductible patients getting VEVI in Q1 that caused the company to have to pay out a lot of money to CVS in the form of rebates, where they might have only been getting $59 in revenue. They may be paying a couple $100, $300 to the PBM for the benefit of getting that customer on.
Yeah, it's a really perverse system. Those patients cost them money in Q1.
New patients costing money isn't a crazy concept. Companies invest money in order to acquire customers all the time. In healthcare, it's just really weird because we try to hide everything that happens under, because there's lots of rules, lots of perverse incentives. So the long story short is, okay, if these customers do work through their deductible and then the insurance plans start paying, they'll get the full price and the margin will be made up over the long run. But my suspicion is this is a company that's done an amazing job of growing this from zero to actually quite a large company at this point. But selling in pharmacy is not the experience that this team has. And I think that they got caught on the wrong side of things. It seems like they've moved relatively quickly to correct them. But it's not good when you have 2 quarters in a row of disappointing your investors. And that's the position they're sitting in now. Our perspective is that the thesis is still together. But it's a 5-year thesis that we were hoping was going to play out in 2 to 3. And it seems like that's not going to be the case.
And I think one headwind they had that they should have anticipated is that the price of premiums increased so much from last year to this year that a large chunk of buyers shifted down to high deductible plans. So there was a much larger pool of high deductible patients accessing the drug, larger than they modeled based on last year's numbers. But that should have been foreseeable.
Right. Well, more on that next week. In the meantime, we'll be here 7 days from now, exactly 7 days from now, and everyone be well and stay healthy. And thank you very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.